Swing trading sounds easy. Low screen time, simple setups, so why do 70% lose? Here's the truth.
Here's the simplest way to think about it. Day traders open and close in the same session. Position traders hold for months, sometimes years. Swing traders sit in the middle, 2 days to several weeks, holding through a piece of a multi-day move on the daily chart. The typical hold is 2 to 10 days, some stretch to 3 or 4 weeks. And the routine is what makes the style different. End of day scan, next day entry, 2 to 10 day hold. Exit at target, at stop, or after about 5 sessions if the move never develops. Total active time, 30 to 60 minutes a day, after the close, not during market hours. That single fact is why swing trading is the only active style that's genuinely compatible with a 9 to 5. Now, here's the catch. Lower screen time does not mean lower difficulty. The retail loss rate on these markets sits between 70 and 85%. That's ESMA's number, pulled straight from regulated brokers. Swing trading is a sub-style of active trading, so that range applies. The 15 to 30% who survive aren't smarter than the rest. They just do 4 things differently. Start with the chart. Across most published swing strategies, Saxo, Schwab, IG, the textbook setups have not changed in 20 years. There are 4 of them. 1. Pullback to a moving average and trend. Price is in an uptrend on the weekly. On the daily, it pulls back to the 20 or 50-day moving average without breaking trend structure. You enter on a bullish reversal candle near the MA, stop just below it. 2. Breakout from consolidation. Price chops sideways for 2 to 6 weeks, then breaks out on rising volume. Entry on the breakout close. Stop just inside the range. 3. Mean reversion. In a defined range, price tests the bottom and reverses. Entry on the reversal at support. Target the range high. 4. Failed move reversal. Price breaks a key level, say a 50-day high, then quickly fails back inside the range. This is the strongest reversal signal of the 4 because the breakout traders who just bought the high are now trapped. Their stop losses become your fuel. 4 setups. Pick one, just one. For the first 3 months, trade nothing else. Here's why that matters. If you split your attention across all 4, you have a quarter of the sample size on each. 2 losing months on a single setup is normal variance, totally expected. 2 losing months spread across 4 setups makes you abandon every one of them. Setup hopping is the single most common reason retail swing traders never develop measurable edge. It's not the chart pattern that breaks them, it's the lack of repetition. But honestly, the setup matters less than what comes next. Position sizing is the part that actually keeps you alive. 2 rules cover most capital preservation. 1. Risk a fixed percentage of equity per trade, typically 0.5 to 1%. 2. Cap total open risk at 3 to 4% of equity. Run the math on a $10,000 account at 1% risk. That's $100 of risk per trade, calculated from the stop distance, not the position size. Here's where most retail traders break. If your stop is $1 below entry, you buy 100 shares. If it's 50 cents, you buy 200. If it's 25 cents, you buy 400. The position size shrinks or grows so the dollar risk stays constant. That's the entire arithmetic. And the reason it works is brutal. A 50% drawdown requires a 100% gain just to break even. So you build the account by making sure no single trade and no single cluster of correlated trades can blow a hole in the equity curve. Correlation matters. 4 long oil stocks at once is not 4 positions. It's 1 position with 4 tickers, because they all move on the same crude print. Your effective ceiling at 1% risk is 3 uncorrelated trades open at any time, not 4 similar trades. 3 independent bets. Okay, setups handled, sizing handled. Now the part that ambushes most beginners. Swing trades carry 2 costs that day trades do not. The first is overnight financing. Swap on a Forex CFD, margin interest on a leveraged stock position. As of 2026, US broker margin rates run between 6 and 12% annualized, charged daily on the borrowed portion. Hold a leveraged position for a week and that's real money. Hold it for 3 weeks and it can be the difference between a profitable trade and a break-even one. The fix is boring. Before you open any multi-day position, check the swap row on your broker's instrument specs page. It's always shown. Most retail traders never look at it. The second cost is gap risk, and this is the one that genuinely catches people out. Stop losses do not protect against opening gaps. If a stock closes Friday at $100 and your stop is at 98, a Monday open at 94 fills your stop at 94, not at 98. The $4 between your stop and the actual fill is the gap, and you eat it. That happens more often than YouTube wants to admit. Weekend news, central bank announcements outside market hours, earnings releases, they all create gaps that walk straight through a stop loss. The defensive posture is to size every position assuming the stop might fail by 30% on outsized news, not as a tail risk, as a structural cost. So if you do all of this right, what's the return? The honest version is less exciting than the YouTube version. Schwab's own swing trading materials target 5 to 10% gains on average winners. With realistic win rates of 40 to 50% and a 2 to 1 reward to risk ratio, that maps to roughly 1 to 3% monthly for a positive expectancy strategy after cost. Annualized, that's 8 to 15% on a small account, with drawdowns of 15 to 25% expected at least once every 2 years. Not if, when. Now compare that to the S&P 500, roughly 10% annualized, long-term, no work. A swing trader has to beat that net of taxes, trading costs, and the value of their own time. Otherwise, they'd have been better off in an index fund and the gym. So the real question isn't, can I get rich swing trading? It's, is the effort and the drawdown worth roughly index plus on a small account? For some traders, yes. For most, no. Knowing which one you are before you start is the entire game. 5 things kill retail swing traders. 1. Setup hopping. Already covered. 2. Moving the stop mid-trade, which converts a swing trade into an unplanned position trade. 3. Position size by feeling, getting bigger on high conviction trades. 4. No trade journal, no way to learn from outcomes. 5. Trading the news, entering on Monday after a weekend headline. Survivors do the opposite. One setup for 3 months minimum. Stop in advance. No mid-trade adjustments. Fixed percent risk, period. Every trade logged. Predefined plan. No news reactions. Now the concrete 90-day plan if you're starting today with $5,000 to $10,000. Days 1 to 14. Read 1 book. Minervini, Weinstein, or Alexander Elder are the standard recommendations. Pick 1 setup. Open a paper trading account. Days 15 to 60. Paper trade only. 1 setup, end of day routine, every trade journaled. Aim for 30 plus closed trades. Calculate your win rate, your average win, your average loss, your expectancy. Days 61 to 90. If expectancy is positive after realistic costs, move to live with 1/4 of your normal sizing. Keep paper trading in parallel. Reevaluate at the 100 trade mark. The plan deliberately front-loads study and paper testing because the hard part of swing trading is not the chart pattern. It's running the same setup, the same size, the same routine for hundreds of trades while everything in your brain is screaming to change it. So the verdict, swing trading is the most job-compatible active style. Lower screen time than day trading, no PDT minimum, real setups with 20 years of evidence behind them. But the 70 to 85% who lose don't lose at the chart. They lose at the sizing, at the swap, at the gap, and at the discipline of running 1 setup long enough to know if it works. Get those 4 right and you're playing the same game the survivors are playing. Get any 1 wrong and the chart pattern won't save you.
Swing trading rewards discipline, not chart spotting. Master sizing, costs, and 1 setup. Full breakdown linked in the description.